Takeaway number 1. Invest at the point of maximum pessimism. In pretty much any other aspect in life, you should go where the outlook is the best. Get a college degree at a university which is generally held in high regards, aim for a job in an industry that seems promising, marry a person which your friends and family approve of, etc. But in investing, you should do just the opposite. In fact, if you don't happen to be best friends with Warren Buffett or the son of Charlie Munger, you can probably use the opinions of your friends and family as a strong indicator of what you shouldn't be investing in. Sir John Templeton identified himself as a bargain hunter, a value investor that always attempted to buy assets that are priced below what he believed was the actual value of that same asset. He says that, to buy when others are despondently selling and to sell when others are avidly buying requires the greatest of fortitude and pays the greatest ultimate reward. This typically means investing at the point of maximum pessimism, in a company, an industry, or a country where the general opinion is that shit is about to hit the fan. For instance, Sir John Templeton made a fortune by acquiring companies at the eve of World War II, investing in Japan in the 1960s, when the general opinion was that stocks from that country shouldn't be touched with a 10-foot pole, and buying airlines shortly after the 9/11 terrorist attack. The basic premises for investing during the point of maximum pessimism is that if the outlook changes, the reward will be truly remarkable. Therefore, strong companies facing known issues that you have good reasons to believe are just temporary make up for good bargain hunting grounds. A successful bargain hunter must focus on probable future events rather than actual current ones. To be able to keep up the mental fortitude to buy when others are despondently selling and sell when others are avidly buying, one must separate himself from the crowd. Templeton didn't just think about this figuratively, he literally moved to the Bahamas to avoid the herd mentality that he experienced in New York. Now, you don't have to go this far, neither figuratively nor literally, because in the coming few takeaways, we will examine a few other techniques that you can apply to separate yourself from the casual investor. Takeaway number 2. So, what is a bargain exactly? Typically, when people buy a stock, they buy into a story. Airbnb will revolutionize the way that people travel. Tesla is making zero emission cool. And Beyond Meat will bring the livestock industry to its knees. While some of these stories may turn out to be true, it doesn't necessarily mean that you should invest in these companies. In fact, you should probably be extra careful when there's a compelling story attached to the company. Why? Because almost without exception, the rest of the investing community will have noticed these compelling stories too, which causes these stocks to trade at very high multiples. To Sir John Templeton, most of them would probably not qualify as bargains. But what did he actually consider a bargain? A bargain to Sir John Templeton was an asset that was priced at an 80% discount or more. In other words, if he thought that the stock was worth $100, he'd like to buy it at $20. This only happened on rare occasions, of course, but it proved to be tremendously profitable nonetheless. Another guiding light for Sir John Templeton was a low PE multiple. Depending on the time horizon of your investment, Templeton had 2 general suggestions. You either 1. Find stocks that are priced so that, using their earnings in 5 years, they trade at a PE of 5. Or 2. Find stocks that are priced so that, using their earnings in 10 years, they trade at a PE of 2. To illustrate, I will take Tesla as an example, just because it is a hot potato. It is currently trading at $163 billion. So, if we use the first criterion, it must have earnings of $32.6 billion in 5 years. By comparison, Toyota, which is the world's largest car manufacturer, had earnings of $23.1 billion last year. Or, if we use the second criterion, Tesla must earn $81.5 billion in 10 years. Currently, in terms of profits, That would make Tesla the second largest company in the entire world. Let's just say that I think some healthy skepticism is necessary here. Takeaway number 3. Investing abroad is no longer foreign. Sir John Templeton was referred to as the Dean of Global Investing. He liked to invest in foreign markets, which to him meant that he invested outside of the US. He had tons of success in countries like Japan, South Korea, and China, especially while these were still regarded as emerging markets. Remember takeaway number 1? Since your mission is to exploit pessimism, you mustn't only do this at a company or industry level, but also at a country level. If you look in the US, you will find some bargains. If you look in Sweden, you will find some bargains. If you look in India, you will find some bargains. But if you look in the US, Sweden, and India, you will find more bargains. Duh! Not only will it lead to you finding more opportunities, it will also increase the diversification of your portfolio. Even in today's global economy, holding stocks from different markets and with different currencies will decrease the volatility of your portfolio. This may help you with the before-mentioned mental fortitude that is required when going against the herd. A common objection against investing abroad is that there's lack of information. It is true that not all markets are as transparent as, for instance, the American one, but lack of information isn't always a bad thing. It could also create opportunities. You just need to investigate the details and reach better conclusions than the rest of the investing community. Beware situations in which you're at an informational disadvantage though. For instance, if there are no annual reports available in a language that you understand, you should obviously stay away. Ignoring details can lead to bad investments in foreign stocks just as well as it can lead to bad investments in your domestic market. Whether the mistake was caused by misjudging a corrupt government or a corrupt top management, your wallet won't really care. Takeaway number 4. The bottom-up and top-down approaches. It's no secret that investing abroad may be different than investing in your domestic market though. You will have to take differences in accounting, culture, consumer behavior, and politics, among other things, into account. It is a worthwhile endeavor, but a time-consuming one. Therefore, we'd like to focus on just a few of these markets, and the question then becomes, which ones? There are 2 approaches that you can take, a bottom-up or a top-down one. The bottom-up approach basically consists of screening a lot of companies. For this, you can use services such as Capital IQ, Bloomberg, or Screener.co. The bottom-up approach starts on a company level. On the other hand, a top-down approach would look at something like the growth of GDP of different countries and see where the potential for growth in the future seems to be the greatest. The top-down approach starts on a country level. Sir John Templeton preferred the bottom-up approach, and he thought that getting a country right begins with getting individual companies right, not the other way around. Here's a quick and dirty attempt of mine to make such a global bottom-up analysis. I screened a total of 54,000 publicly traded companies using Screener.co and the following criteria, which doesn't come from the book by the way. This narrowed down the 54,000 companies to only 226. Take a guess. Where do you think that most of these companies could be found? The US? Nope. Sweden? Nah. India? Close, but no, not that either. Most of these, let's call them qualitatively undervalued companies, could be found in Vietnam, China, and Russia. The top 10 list looks like this. As mentioned before, you must be very careful not to put yourself at an informational disadvantage here though. What do you think about investing in Vietnam, China, and Russia? I'd love to hear your thoughts in the comments section. Takeaway number 5. Master 100 yardsticks of value. Sir John Templeton always said that there are more than 100 yardsticks of value that an analyst can use to find bargains. The primary advantages of knowing more than one way to find value is that you can find it during many different conditions, and that you can confirm your bargains from many different angles. Here are 6 yardsticks for you. Soon you'll only have 94 to go. A low PE. As mentioned earlier, Templeton didn't want to pay too much for the earnings of a company. A low price to book. The book value is the value of the assets of a company after deducting all liabilities. Benjamin Graham famously was an advocate of buying stocks that traded below their book values. Lots of acquisitions in an industry. Companies usually know their competitors really well. Therefore, when there are a lot of acquisitions going on in an industry, it's a sign that insiders think the industry is undervalued. If companies are willing to bid up their competitors, let's say 50 to 100% or more before acquiring them, it's a strong signal that there are bargains in that market. Companies are buying their own shares. Similar to the last point. If a company is acquiring its own shares, it should mean that the insiders think the company is undervalued. Lots of money on the sidelines. This is an indicator of a market that is undervalued in general. When the largest institutional players are sitting with tons of cash on the sidelines, it's a bullish sign. Eventually, this money has to go somewhere, and this will drive stock prices upwards. Absence of IPOs. The insiders want to get as much money as possible for the companies when they go public. If there are no IPOs in the market, it means that most insiders think the stock market prices are too low, and vice versa. Follow the insiders. They typically know their businesses better than you do. To take one step further towards mastering 100 yardsticks of value, you should check out the book that I will cover next week, The Little Book of Valuation. It covers how to value a company, pick a stock, and profit. Cheers guys, see you soon.